Hello, my name is Riley Gross, and today I will be talking about market efficiency and behavioral finance. Specifically, we will be looking at the GameStop short squeeze in 2020-2021. So going straight into that, we have our assignment right here. So for anyone that doesn't know, in 2021, 2020-2021, people on a subreddit called Wall Street Bets figured out that they could mess with the GameStop price. So ultimately, a bunch of them invested in GameStop, and it started rising. And GameStop was trading very, very low. It was the market volatility was almost at 1, and it wasn't really having much returns. Wasn't a great stock to be invested in. But that's kind of the point of today, is that how markets can shift by people's behavior. So first off, I will be utilizing the driver framework to go along with this, and I will also be utilizing Python, which we will get to in a second. But first, I use Gemini, put my prompt in to get the Python code, and then I said, I'm a finance studying this specific market efficiency and behavioral finance. I'm looking to make a video, and I want you to make me a Python script that would allow me to better understand this case study of GameStop and the short squeeze that happened. So next thing, going to this. So the first kind of problem we were given was that it said GameStop was trading at 4 cents in August of 2020. Now, just looking up the GameStop price in August 31st of 2020, in all of August, we can see it was trading about $1. You can see it was going up some every day at open of the market, and closing at a higher price pretty much, or for the most part, especially towards the end of the month. So kind of the start of these people on the subreddit influencing the market some, when you get enough people to factor into it. So the next thing that I will go over is kind of our second stage. We already went over the define, the problem, and the answer to this one, the inaccurate data would be look up the data. We clearly saw the opening price and closing price and anything in between of that GameStop data. It was around $1 to, I would say, $1.50 in August of 2020. So a way to correct that would be, show them the actual financial data to your professor. That way they can kind of understand that. And then just more, I already talked about this, but the Wall Street Bets, they made the price surge all the way up to $483, and then this was ultimately market manipulation. But it shows how people can affect these markets. So moving on to our represent stage, we're going to be going over our Python code. So I imported pandas, numpy, matplotlib, stats to give us data for this, and as well as for the graphs to show us some good visualizations of what actually happened with the market and how it was manipulated. So we have the split adjusted numerical here at $1 for August 2020. And then we have these ranges of dates that it's giving us to help show in the visualizations, and then giving us numbers for our specific beta scores, as well as the stock price. That way we have some way to graph these based off of historical data. And then we're looking at our squeeze returns right here. And then the overall returns and what it was, also based on historical data of the GameStop stock price and how it increased and then eventually flattened out after they already kind of took advantage of the market. And some people gained themselves a lot of money. And then here are the prices calculating returns based on the split adjusted price, and then more series data for specific dates. And then we're also additionally comparing this to the S&P 500, which is the market itself essentially, and seeing how it was manipulated. And then all of these are just graphs. So going to the output here, we already discussed that the actual stock price was hovering somewhere around $1.50 for GameStop in August 2020. And then we will be calculating abnormal returns, which is basically just the actual return minus the expected return. And we're going to sum all these up to get our cumulative abnormal returns. And our expected returns is just the beta of GameStop times the return of the S&P 500. All right, and then going to our first graph right here, we have the squeeze. So the adjusted close price of GameStop in 2020 was very, very low. And you can see down here, so this is October, so it's hovering around $4 at that point, and then it's kind of staying steady until about somewhere in January. Then it starts to rise, as well as the volume of people buying GameStop. You can see it continually go up right here. Its adjusted closing price. So this is all due to this subreddit buying this stock and figuring out that they could manipulate the market. You can see here the volume is very vast in between January and February. So scrolling down a little more, this is what we just calculated, or we're talking about the abnormal returns. So the cumulative abnormal returns is the actual minus the expected. So GameStop's hovering right around 0, which means that its actual returns was very close to what the S&P was basically predicting that its expected returns were going to be. So it was pretty, and based on its beta score, it was, we can kind of compute it almost ourselves, or estimate what it would have been, because it's hovering right around this market price, what it's actually happened and what it was expected to. But in the middle of January, like the other graph, we see a large rise in abnormal returns, meaning that the actual return was much higher than what it was expected to be. The market didn't understand this, right? So we actually had a peak in January of 355% cumulative abnormal returns. So this is all the days combined in this timeline here. So yeah, right here we even say the spike is proof of an anomaly. That line should be right around 0, or the market price. So the next one is the beta score over time. So this one starts in January 2020 and compares it to January 2021. It had a fairly moving with the market. Its beta score was close to 1, kind of fluctuating up and down, but on an average it was close to 1. Now it spikes some in June, but then it kind of goes back to normal. But you can see in January 2021 it drops drastically, 0.4, so it's moving against the market completely, almost at a 0 beta, and then it spikes way high, super volatile, and that's because the market didn't really realize what was happening. This isn't something, this squeeze, especially at this level, isn't something that happens a lot. And then you can kind of see it die down as the months go on further into 2021. But the market wasn't expecting this short. So while it had a normal beta of 1.07, and then this peak squeeze right here, right in January, was basically the time that all these people invested in the stock, and it completely messed up the company's, or the stock price's volatility. The market eventually adapted, but it didn't exactly know what to do at that point. So going back to our driver framework. We have now implemented, we have validated, we looked at the implementation was the Python code, and then the validation was these graphs we just looked at. And then the evolution was looking a little further. In that last one, looking at the beta score, how the systematic risk or the volatility changed due to this market anomaly in which people raised the stock price in its returns from only about $1 to all the way up to 483. Very, very large increase. So moving on to the reflection stage. In hindsight, this analysis shows that markets aren't perfectly efficient. You can see that this is a great example of this because there was a semi-strong form of the efficient market hypothesis, but it was broken due to this frenzy of people using publicly available information, buying up this stock. Now you might say, these are just individuals, why didn't maybe a hedge fund try and short this stock the other way? It's because they couldn't. There was so much chaos within the market and such a strong sense of hurting with the people that invested in GameStop stock that they couldn't end up shorting this the opposite way to bring it back to market price. They knew it was completely off, but these people had manipulated the market, given public information. Now, some things to ponder on, now that we understand and went through this case, went through the driver framework, is that when there's publicly available information and people utilizing things like that to short the market, something to keep in mind is that, is it ethical? Should you give this information to others if you have certain information, maybe not necessarily insider information, but information that could help you, in which it can also crash the market? So the main idea here is that markets aren't just simple values of money. They're very chaotic, complex, they're not perfect. They also take into account human behavior, as we can see here. Many people, or people working in a group or a herd, they can control a lot more than you think. And it shows that, kind of like brings in risk into the factor. That is why there is risk, because markets aren't perfect. If they were, it would be easy to calculate and everyone would be investing. Thank you for listening today. I hope you learned more about market efficiency and behavioral finance.